Welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. Joining me in the market site at Times Square, we have Chuck Self is back with us. He's the Chief Investment Officer over iSectors. We're going to take a look at diversification in the time of negative interest rates. Chuck, as always, thanks so much for joining us.
Thank you, Jill.
At market site, and interesting, over 25% of global bond markets have negative interest rates.
Isn't that amazing? $13 trillion, the most there's ever been in bonds of negative interest rates. It's not clear that they have really pumped up those European and Asian economies that have them, but they're there, and U.S. investors that are investing in global or international bond funds have to recognize that they're there.
If you have negative interest rates, why would you put your money into bonds?
Well, usually the reason why you own international bonds is mainly because of the currency diversification that it provides you. It's another source of diversification that's not correlated with other sources of diversification. And so having having the interest rates that you get from those bonds while you have the currency diversification is usually a positive thing. The problem now, of course, is that you got a large portion of these markets have negative interest rates, and you could have, there are ETFs out there that are international ETFs that have negative yield. And that's even before their expense ratios. So investors are going to be surprised, I think, at the low returns you're going to get from those.
Yeah, I mean, you're not putting your money to work at all. In fact, you're losing money.
Well, yeah, you're losing money, and at the same time, you're taking credit risk because only a small percentage of the issuers of international bonds have AAA credit ratings. Even if they're governments, they usually don't have AAA credit ratings, and of course they're still exposed to the interest rate risk that you have in bonds. When interest rates go up, bond prices go down. So you're taking on all these risks and the currency risk, and yet you're not getting any yield for it.
What can you substitute in the portfolio to get some kind of yield out of it?
Well, I think there's still very few opportunities to get yield out of the diversification portfolio, but that's what we're trying to tell people, is that you got to start thinking more broadly as far as with the bond portfolio and its role there. Its role is really to provide diversification with equities. And so we think that you should further diversify the diversification portfolio by owning gold bullion funds. They have currency exposure just like the international bond funds do, but there's no credit quality. Gold is gold, and the funds that own them have actual gold in vaults outside of the U.S. There's very little interest rate risk. And you're not going to have negative yields. You have the expense ratios, but they're
they're minimal on the gold bullion funds, right?
In the last few years, they have come under 0.2% or 20 basis points expense ratios, and many international bond funds have 35, 40 basis point expense ratios, and they add that on after the negative yield you're getting. So it's not that we should forever not own international bonds, but we really should diversify the diversification portfolio to own gold bullion funds.
All right, so we've covered diversification. Let's get your market outlook for the second half of the year. What are you going to be paying attention to?
Well, we continue to feel, and the way we invest is to try to minimize downside risk. And we think that U.S. Treasuries are the best asset class to minimize downside risk. Interest rates have come down a lot, and they may not come down much more, but we don't think they're going to be going up at all. Whereas if a recession is coming in early 2020, or maybe even at the end of this year, the equity markets may have a 10, 15, 20% decline here, like in the fourth quarter of last year. So we are continuing to feel that you should continue to have broad diversification in whatever portfolio you have.
And it'll be interesting going into the election because the market and the economy is one of the bright spots.
Right.
So you would imagine they're going to want to keep that relatively steady.
Right, yes. And so it's going to be, again, we don't know what going into election, going into a potential recession, going into a change in the Fed interest rate regime, exactly what the impacts are going to be. So broad diversification, which we talk about all the time here, is still going to be the key.
All right, Chuck, as always, thanks so much for joining us at MarketSite.
Okay.
And thank you for joining me on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.